Well, I want to thank everybody for having me. Reed, you're the man. I appreciate you taking the time and inviting me out. We're going to talk about how to trade weekly options today. And, before I get that, let me talk about myself, which is really my favorite subject. I like myself so much that I named somebody after me. Think about it that way. Um, but no, really, I was a floor trader for about a decade. Since then, I've been trading for myself, obviously, and then doing education and consulting. So I will, on the retail level, we built some, professional level education that's designed around retail traders. And then on the institutional side, I'll go into a hedge fund or a money manager and I'll try and break apart their option strategy, or I'll try and optimize it. I'll stress test, all sorts of stuff like that. That's so. I like to joke that I've worked with people with $1,500 and $15 billion, and usually it's the person with $1,500 that gets options a little more than the guy with the 15 bill. It's kind of scary, but that's the way it is. So here's what you're going to learn. You're going to learn how option time value decays, how the pricing model breaks, all right? The advantages of using weekly options, the disadvantages of using weekly options. I'm going to teach you how to use some strategy around them, and I'm going to give you some basic use of directional trading, and I'm going to use an example of something we might use in option pit. So options are just another form of insurance. As time passes, insurance policies lose value. All right. Even on the last week, insurance policies still have some theoretical value because they're insuring against an accident. All right. Much like insurance policies, options decay with the passage of time. All right. Up to the last minute, an at-the-money option will have lots of insurance value. All right. When I was a trader, a pinned stock. And pinned means it's sitting at the short strike. Going at expiration, the straddle would still be worth 20 cents. And so there was still a lot of kind of decay and a lot of value going out on that trade. So now how at-the-money options decay. All right. So this is kind of the classic example you'll see from your regular guy saying, oh, options decay exponentially, and so you want to trade inside 30 days, and as time passes, decay explodes. And that is absolutely true for at-the-money options. And that's the key thing to remember. That is true for at-the-money options. All right. The thing to remember is that at-the-money option premium decays exponentially. It gets faster and faster and faster. All right. It's one of the real values of trading weekly options. All right, we can get short just the exponential part of the curve. All right, in theory, one should be able to harness lots of premium selling weekly options on a regular basis. So theoretically, there's lots of premium to harvest. All right, if one sells weeklies, and that's especially true with at-the-money options. So it sounds super easy. But is it really that easy? All right, and the answer is no. All right, the previous chart only applies to at-the-money options. The further from an option, an at-the-money option is, the further from at-the-money an option is, the more linear its decay. All right, so an option that is at the money has that exponential function. An option that is not does not. It is much more linear. Linear means straight line. So let me kind of show you an example of what it might look like. All right. So you see at the money, you get this kind of real selling, whereas out of the money, that is a much more linear function. So if you're given a chance to flip a coin once, and if it lands on heads, you get $1 million. And if it lands on tails, you owe $700,000. Would you do that coin flip? What do you think, people? Would you do that coin flip? So I'm going to flip a coin, and if it lands on heads, I give you $1 million. If it lands on tails, you give me 700,000. I am not aware that I'm showing the wrong side of my screen. Thank you for telling me. I meant to show this. All right, so Angel, you're clearly rich because $700,000 doesn't mean much to you. All right, so who would take this bet? All right. The answer is most people. That is how casinos win their money. That's not true, Rick. All right. I was enjoying the preview. Most casinos make their money, do not make their money by doing these trades once. You know? Right. Casinos do not make money by doing it once. All right. For most people, even though the risk, even though it has a positive expectancy, the risk of losing such a huge sum amount isn't worth the upside. Okay? That is the key. All right. So what if you got to execute that? What if you execute that coin flip 50 times before the side's paid out? All right. So would we do that coin flip? So you do that coin flip. Then would you do it 50 times? The answer is yes. Absolutely you would. All right? And this applies, this concept, this idea of, you know, an extreme event affecting you once is one of the reasons why teeny options, why traders close teeny options, and why traders don't want to sell inexpensive options. All right? And this applies to the weeklies. So I want you to think about how that might apply. All right, so both at the money and out of the money options can decay to the point where they start to act like our coin flip game. All right, while the sale of an option at a nickel may have an edge to it, all right, or holding one to that to the expiration for that matter, because of the risk associated with being short teenies, inexpensive options, and the margin most market makers do not like to sell them and work to close them. There's margin associated with carrying those options. All right, and so haircut. And there is a, you know, there is the real risk of one of those teenies blowing up. So this is the real decay of option premium, all right, over the life of an option. Once options get cheap enough, the decay starts slowing down again. So think about that. Yeah, they have exponential decay until they get to a certain point, then they stop decaying. So, you know, it begs one to question the risk-reward of certain types of approaches in weekly options. So this is all related. All right, let's circle back to where we just learned to discuss where there's edge in weekly options. All right. The last week of an option's life has a huge amount of decay when it's at the money. Decay is fast at the money. Okay? For out of the money options where that decay is linear, all right, making this week very similar to last week. Thus, there's not much edge in selling out of the money options. All right? And the last nickel doesn't decay for a very long time. So we're kind of putting together a puzzle now all of a sudden. All right? So we've got at the money where things decay fast, out of the money where things decay linearly, and then way out of the money where things just don't decay. So let's get some immediate takeaways here. All right, at the money option prices across the month. So take a look at the April 10 calls, the April 10 36 calls in GM with 2 days to expire. They have 30 cents. The May calls with 22 days to expire in this case have 95 cents. So there is an amazing amount of, there's an amazing amount of premium that just comes out in the final 2 days. But now let's look at out of the money options across the months. All right, so let's look at the April 37 calls. All right, there were 14 cents with 9 days to expire. All right, the May regular calls are 51 cents with 22 days to expire. So which option actually is going to produce more decay over the next 9 days? So think about this. How many times does 9 go into 22? We'll pull up a calculator for you. Nine goes into 22 2.4 times. All right. So what is 14 times 2.4? What is 14 times 2.44? 35 cents. So I actually am getting better edge, more premium decay out of my May option than my April option. Does that surprise any of you? $1 out of the money, and I collect more 22 days than I would 9 days times than the equivalent number of days if I was just short at 9 days to expiration every week. That is because options don't decay in the way that you were taught. Now let's look at these teenies. So take a look at this. This April option expires in 2 days. And here we are, $1 out of the money. And the 37s are bid and the 35s are bid. Full buck away. So the 37s are worth 3 cents. Next week's are worth 14. There's a ton of premium still to come out. So over that 7-day period, you would only collect 11 cents. So anybody here like to do like weekly condors or weekly strangles? Yeah, it doesn't seem like such a great idea anymore, does it? You're not harnessing the premium where it actually is producing the most for you. All right, you are not harnessing the premium, the right premium. You'll make more money selling out-of-the-money stuff further out than you will doing weeklies or straggles. I would rather sell the 37 call that expires in May than the April. I'm going to make a lot more money. And these teenies never decay. So here's the lesson. Weekly options are for near the money. That is where the edge is. All right? The edge is not just the guitar player for U2. The edge is selling at the money options in the weeklies. If you are selling out of the money options, you are giving away money. And you should be trading in the further out weeks. What is a teenie? A teenie is an ultra inexpensive option. It comes from the word 1/16. We used to call them, when they would price them in fractions, you'd say 1/16 and you'd call it a teenie. All right. Anything under a nickel is you're better off closing and rolling back. You will make more money closing your options under a nickel and rolling back to a new short. All right, so now, should one always sell weekly options when one is trading near the money? What about covered calls and cash secured puts? There is a trade-off, and it can be costly. All right, in return for the extra premium, the trader is taking on more price movement exposure, otherwise known as gamma. Thus, if all goes right, a trader will make more money selling 4 at-the-money covered calls than 1 monthly call. However, what if the underlying really starts to move around, up and down, side to side, all over? The monthly will have much more raw premium. Thus, one is able to wait out the pop. All right? The weekly option just expires and may take one's stock away if it's not bought back. Or worse, the trader covers and then the underlying drops again. Weeklies are for more seasoned traders in that sense because the gamma exacerbates the need to close worthless options. All right, if you're trading weeklies and you are not shutting them down when they get worth less than a nickel, you are taking unnecessary risk. Right. Generally speaking, there is edge in selling just out of the money options in the weeklies and hedging them with further out of the money options. All right, because of the hyper decay of near the money options and the linear decay of out of the money options, credit spreads can make a lot of money quickly. All right, options should have some teeth, but not be hyper. All right, what do I mean by that? Don't go trading weekly credit spreads in Netflix. All right, trade them in something like IBM, or with that its moves has some volatility, but it isn't going to put you out. That's a good point. All right, it's always worth it to close those. So let's look at a trade. just an example. And I'll pull up one more recent. So this is IBM. All right, and we're looking at the April versus the May. All right, so if I do the May 162, 167 call spread, I'm going to collect about $1.80, $1.90. And that's going to be, at this point, that's, about a month out. If I do the one expiring next week, same out of the money spread at this time. I only have to carry it for a week, and I'm getting $1.25 out of it. And this April option is going to take forever to decay. The real edge is in weekly options is strategic placement of the option trade. One can pinpoint where one wants to take long risk and where one wants to take short risk. All right, one value of weekly is determining how much we think a stock might move on earnings. All right, Best Buy is trading $77.68. The market is expecting a move of about $4.20. So, weeklies are great. Let me show you kind of what I mean by that. Just make sure I'm going to switch screens here. All right, so let's look at, let's look at what Google was actually pricing in. We all saw what Google did yesterday, right? Crazy move. So Google, now this is a monthly option, but it's a weekly. Google was going to report on the 16th after the market. And here we are on the 16th at the close. It's trading $600. So the market was pricing Google to move about $25. Okay. I don't like Toss's market maker move. I don't think that's very accurate. Yeah. So this was $25. It was off. They underpriced the move by $75. Netflix. You don't, but you can figure out what the market is pricing the move, and then determine whether they're right or wrong. This was one we did kind of get right. We said, okay, here is Netflix trade $98, and they're pricing a 10% move. And we said ourselves, we thought that was too cheap. So we went out and traded, I did like a little bear broken wing butterfly that made $5 because it went up instead of down. But there were some smart ways to go for out of the money options because we were informed on how much the market was thinking the underlying is going to move. All right, I personally hate earnings plays. All right, they are such a crapshoot that I almost never do them. All right, I'm smart enough that I can make money without there are much smarter ways for me to make money than trying to take a lucky stab at earnings. But those weeklies do give us that information, which is great. You know, so I'm trying to think who's got earnings next week. IBM. Trading 172. IBM is going to be Monday, so that's nice. And if you look at the July 24s that are next week, they're pricing in, you know, obviously there's a little decay. All right, I can look at last week. $170. They're pricing in about a $2 move last week, and this week they're pricing in about a $6 move. So they're $6.30. So they're saying it's an extra $4. Well, yeah, I don't think that's a great. I don't think that's that great of an. I don't think that tells you anything. Apple, yeah, Apple. Sure, we can look at, you know, Apple. All right. So this time on Monday, Apple was trading 126, and the straddle was about $1.40, $1.50. And today, I mean, the straddle is the straddle is the market's guess that the move is going to be about 58% or less. I don't know why this is taking so long to load. There you go. So they're pricing in now for this week, call it $6. So, you know, an extra $5. $4.50. So a straddle is just, I'll move back to the other one. A straddle is just is the market's guess that at about a 58% odds of the underlying moving that much. All right, now, so there you have it. So we've got kind of the information piece that we discussed. Now let's talk about strategery. All right. Tesla has a product announcement on May 1. All right. I can also see, just by looking at the IVs, when the market thinks earnings will be. All right. If I want to play either, I know where to place the trade. And that's because I've got these weeklies that show me where information is. 58. I do not mean 68. The at-the-money straddle is only about 80% of standard deviation. All right. So let's look at a real Tesla trade. This is the one that I was actually playing with on Friday. All right. Tesla, after tanking, has had a nice little recovery. The stock has moved up and down some, and I want to fade this little move. All right. I can use strategic weekly calendars to place a bearish trade while reducing my risk associated with the bear position. So how do I build this trade? I buy the announced weekly put slightly out of the money. I sell a near-term put that is also just out of the money. Thus, I'm harnessing that weekly decay all right? I'm harnessing that weekly decay, and then I am strategically buying the firmer one. All right? and I end up getting short delta. And theoretically, I can end up with a cheap put that I can turn into a new calendar or a new diagonal. So here's like a trade I might set up in Tesla. Like, I think Tesla is going to back off this week. So I would buy the earnings cycle, which is the August 7 weekly, and I would sell the July 24. All right, and I love using weeklies in this manner. All right, I just gave it using the what I call the earnings anchor. And there is what my calendar ends up looking like. You can see I've got a bearish delta, a little bit. I'm collecting theta, and I'm long this vega that is not going to decay. All right, so other uses for weekly options. I can use them for the wheel. All right, I can use them for butterflies. I love weekly butterflies. Talk about harnessing decay. You're buying the out-of-the-money option and selling that decays slower, and you're selling an at-the-money option that has that explosive decay. Weekly butterflies, can be great if you know what you're doing. Standard calendars and double calendars, directional calendars like I just showed. I do not like weekly options for iron condors. I think they stink for that. So in summary, decay is more nuanced than many people realize. Weeklies can be good for credit and debit spreads. Weekly value is strategic placement. And weeklies are great to finance directional opinions. Do you do mostly broken wing flies or regular flies? I do a lot of broken wing butterfly trading. All right, and then here's my offer. I have a 50-minute course on trading credit and debit spreads, all right, that would normally be $197, that I'm going to sell through Tuesday at $12 to the first 200 traders. You're going to master buying versus selling. You're going to execute credit and debit spreads with precision. You're going to extract more dollars. I'm going to teach you some really cool tricks. You're going to pick the right strikes to buy and the right strikes to sell, and I'm going to help you minimize that risk. You go to optionpit.com/option income to buy it. $12. That's 2 cups of coffee. And the idea is you will learn something, you will like it, and then you will buy more from me. All right? And I will be straight up honest with that. If I give you something you like, you will get more. You will want to buy more things you like from me. All right? Now, do we have any questions? Sure. Yeah, one common misconception about straddles is that is the standard deviation. It is not. All right? It is about 80% of the standard deviation and represents about a 58% probability of the move. Will I give actionable trades? Well, it's a recorded thing. I can give you an actionable trade right now. Give me a stock you want to look at that does not have earnings. Oh, you already bought the silver course? It will. If you bought the silver course, I'll just give you that for free. Shoot me an email. All right, so let's look at Google. All right, and I'm going to switch to my screen here. Read it. I've got 5 minutes.
Correct.
All right. All right. Optionpit.com/option income. I will show you that it works. Let me build this. Let's not do Google because it just moved $100. now that I think about it. This is not a good one for debit or credit spreads because it's probably going to keep going. You know, Netflix is kind of, that's a little bit of a widowmaker. Let's look at Goldman Sachs. Or did somebody throw out Visa? Did they have earnings already? No, they have earnings coming up. So let's look at Goldman. All right, yeah, link works for me. So Goldman, I'll just show you how I analyze this stuff. See, Goldman, you know, it basically bounced off the 200-day moving average, sold off, you know, had a kind of an ugly earnings, but has kind of since recovered. You know, and that 200-day moving average has been a really good bottom for Goldman. So then let me look at the volatility. Now, if you don't have a fancy chart like this, you can see that vol's low. There is the symbol VXGS, which is the Cboe Goldman Sachs VIX. Very similar. All right, and then I'm going to pull up the option. I want to pull up the options just to see what the term structure looks like. And all right, so I definitely am not less interested in calendars. Although I might be interested. I might be willing to do like the August, July 31 call spread, or July 31. I might be willing to do that as a calendar spread. You know, I bet you, let me see how that would look. So I could do this, and see, this is how I can use weeklies to my advantage. So I can kind of sell here, buy the regular August, and I can do like 10 of them. And then I might look at August and say, boy, that volatility is cheap enough. You know, why don't I buy like, you know, 1 or 2? Oh, what is Sigma? Oh, that's the volatility, the at-the-money volatility. All right, so I might say, you know what, I'll buy. If this thing's really going to break out, it's going to break out lower. I'll buy, you know, like 1 or 2 of these cheapy puts at the 205 strike to deal with my delta. That's a little too much negative delta, actually. So the nice thing is I only have to buy 1. So this would be a very option pity trade. Right, but if I was going to do just straight, if I want to do a straight credit spread, I would go to July, and I would do the 210, 207.5 put spread, and I'd collect 41 cents on that. I think that's a good spread.
Mark, you got about 1 minute left, my man.
All right, I might look at the 212 if I was bullish. All right, so any other questions? I got time for like one more. Go to optionpit.com/optionincome. Do you go into detail about gamma and calendar spreads in your presentation? I definitely talk about gamma. Gamma is the number one risk. Gamma is what blows up traders all the time. All right, and like I said, it's $12. What's going to happen? Well, with Vega, weeklies are less Vega sensitive, but yeah, I mean, that's an important piece. And generally speaking, credit and debit spreads don't have a lot of Vega risk. It's usually gamma that blows people up. All right, guys, any other questions? I think my time is up. And so I will say, let's make the most of this beautiful day. Since we're together, we might as well say, would you be mine? Would you be mine? Won't you be my neighbor? Won't you please? Won't you please? Please won't you be my neighbor?